Who better to talk about oil and the global economy than with Jim O'Neill? On Friday, right after the blowout of U.S. employment data, we spoke with former PIMCO co-CEO and Bloomberg View columnist Mohamed El-Erian, and he stressed how economic strength here creates a gap with the rest of the world.
It's really interesting news for Wall Street because it raises not just the policy issue in the U.S., but this increases the divergence between the U.S. on the one hand, that is healing very quickly, and on the other hand, Japan and Europe. So we're going to see major movements in the currency markets. This is going to be really interesting to see how Wall Street digests this number.
All right, well, creating this big divergence. I want to get in some reaction from another Bloomberg View columnist and former chairman of Goldman Sachs' asset management, Jim O'Neill. Jim joins us on the phone from London. And Jim, do you agree with Mohamed that the jobs data, the U.S. economic numbers are all creating this big divergence where the U.S. is on one side and the rest of the world is at an extreme on the other?
Well, it's quite nice to hear my pal Mohamed sounding a bit cheery about life, I have to say. It's good to hear. Do I agree with that? Not fully. I mean, I think he's right relative to Europe and Japan, although there's obviously a very important connotation for relative monetary policies in that regard, and one of the reasons why U.S. bond yields probably trade so well despite the U.S. data is because of the U.S. and Japan. But where I disagree is with respect to the rest of the world, as I articulated in my last piece for Bloomberg View last week. Even though China is so-called slowing, its 7% growth this year will add twice what the US is adding to global GDP. And India is picking up. So I think a lot of people still don't really seem to get how the contribution to global GDP is changing. And other interesting thing in that regard, I often love it when market signals agree with the way I look at things, and yet the market consensus chatter is different. Because, of course, as of the past week or weeks, Chinese stock market is one of the strongest performing stock markets in the world.
It has, despite the data that came out overnight, though, Jim.
You mean the import softness?
Yeah.
Yeah, that was a bit surprising. I'm not sure how necessarily consistent it is with other things, but if that would be accompanied by further evidence of slowing in all the domestic data we're going to get the next few days, then that would raise issues about the cyclical momentum of China. But as I say, even at 7, the last numbers we've seen have been above 7, but even at 7, it's still contributing twice as much to the US, and yet everybody on the planet is bullish on the US, and seemingly other than me, everybody's bearish about China, which seems kind of ridiculous. But there you go.
Jim, you mentioned India. Two of the outperformers this year on the OECD's leading indicators list are Indonesia and India, and we tend to talk about fundamentals. Are we learning that governance matters with Joko Widodo and Narendra Modi? Are we learning that actual real plans by real people to make changes have an economic effect?
Actually, I think that's a really important point. If you reflect back over the year, when so many people seem to be so concerned about so-called emerging markets, it's interesting if you look at how markets and countries have performed. The ones where there appear to be improvements in governance, and with it some reasonable signs of positive economic reforms, they've been rewarded. And Indonesia are two of the biggest. So I think it's a really important recognition for both those leaders, but it should be a sign to some of those other countries that have not been embracing reform, such as Brazil, for example.
Jim, it's Olivia here. I want to ask you a question about a recent article you wrote for Bloomberg View on Italy, wondering why such a wonderful country, as you call it, and as we agree, struggles perpetually to succeed. You wrote that you always presumed Germany would do whatever is necessary to protect Italy from the kind of financial blow-up that hit Greece in 2010. Now, though, you are starting to wonder. Do you think that it is fair to say that the narrative just so simply that Germany refuses to back U.S.-style quantitative easing, or is there a real argument here that you are pushing on a string when bond yields are already so low? The Italian 10-year is below 2%, that pushing them much further lower won't do much, and pushing the euro further lower won't do much, given the fact that a weak yen certainly didn't help Japan.
Well, I think there's valid issues about the limitations of QE and the euro declining, but importantly, it shouldn't let the ECB off the hook, and it's very, very interesting to see Mario Draghi, I think it was in his press conference, if not his statement, use the phrase illegal about the ECB not reaching its inflation mandate. And I've been discussing it a lot in my role as visiting research fellow at Bruegel with some fellow researchers there, a big European think tank, that, the Germans go on and on about how illegal QE may be, but they signed up to, and in fact almost predominated as to why the ECB has an inflation target of just below 2%. And they need to do things to respect that. So just dismissing any unconventional forms of monetary easing because they're not comfortable with it is just not really acceptable. It's not good enough.
Jim, I want to bring it back, though, for one last point on the U.S. Following that data on Friday, both Mohammed and Alan Kruger said, look, it looks like the Fed is going to raise their interest rates starting the summer of 2015. What do you say?
Well, it's always so tempting to think that, and I'd have leanings that way. But of course, we're in a world where the inflationary pressures still seem to be so modest. And you guys were chatting about oil before I came on air, so that's going to, at the margin, add to that pressure. And we have a very dovish Fed led by Janet Yellen, even more dovish than Bernanke. So, I'm not convinced that that's the path, but at the margin, Friday's numbers obviously shift things a bit more that way.
All right, Jim, thank you so much. Jim O'Neill, Bloomberg View columnist and former Goldman Sachs chief economist. Thanks so much for joining us.